We okay, great. Good afternoon, everyone. I'm Sanjeev Mota from B&K Securities. Welcome to another Fireside chat. We have with us Mr. Ravi Jakhar, who's the Chief Strategy Officer, Cargo Logistics. We also have Ankit, uh, who's part of the group as well. And uh, Ravi, we also have Sailesh Raja, who looks at the stock. So, Ravi, the way we'll do it is I will start with my Q&A and we'll ask slightly more strategy questions and organization level questions. Then Sailesh can take over from there. That's okay.
Sure.
Okay. Great. Okay. So, Ravi, you guys are one of the few multimodal logistics company, probably the only listed multimodal logistics company in India. So maybe just to kind of for everyone's sake, talk a bit about the business model. What is this multimodal? Like, what all are you all into? Can talk just very briefly about that. That'll be great as a starting point.
Yeah, sure. So I think, as you rightly put, we are a multimodal logistics company focused on in the logistics and supply chain, and also using integration not just in the physical but also in the digital sense. So primarily, we are into four core businesses, which comprise the first and the largest is our ocean freight business, wherein we do ocean freight consolidation as well as full containers that operates in the international supply chain vertical, which is under EQ Worldwide. The second key business for us is CFS ICD business, which is again focused more on the EXIM trade. And then we have two businesses catering to the domestic logistics requirements. One is contract logistics that we do under our subsidiary ACCI, and express logistics, which we do under our subsidiary Gati. Across all these businesses, we are primarily B2B focused, and therefore, from a customer standpoint, whether it is EXIM or domestic requirement, we cover 99% of the pin codes in the country through Gati, and we cover more than 180 countries globally through our EQ Worldwide network. And with gateways also secured in form of CFS ICDs, we are in a position to provide a very differentiated, unique logistics services which are integrated. So the customer can access the entire suite of services from one company. So that's the advantage in being a multimodal operator. And that's what we primarily do across these four key business segments at Allcargo.
Sure. And if I see last few years, you guys have been trying to, at least last couple of years, you guys have been trying to morph the business now into slightly more asset-light business and so on. So just trying to let's if we go by how things are. So on one side, you are getting out of things, and I'll come back to the stuff that you're getting out. But you're also acquiring stuff, especially on the ECU worldwide and so on. So what's the overall strategy from what are you guys trying to achieve?
Yeah, so I think the strategy is very clear. If you look back at the history of Allcargo, we have mostly been pioneers in the businesses that we have started, be it the container freight stations, be it the LCL consolidation, which we kind of established in the country, or be it the acquired company Gati, which also shares the same DNA, having been the company that brought the concept of logistics to the country. So we've always been pioneers and a company which is always looking forward to opportunity of future. And in today's time, if you look at what the future customer requirements are, the one thing which we clearly see is digitized solutions, which means that be it customer platforms, be it backend service integrations, the whole ecosystem is evolving into a digitized supply chain. And therefore, we are very clearly focused on digitally enabled businesses. The other key thing which has happened over the last few years and is likely to continue to evolve in that direction is that assets are getting dissociated with the business proposition. And you have asset owners and you have people who run businesses. An easy example, which perhaps everybody could relate to, is Uber. which today is perhaps the largest taxi operator without really owning the taxis. And that's a very similar value proposition to what we do in our international freight business, wherein we operate thousands of freight lanes and port pairs on weekly scheduled services without owning any ships. We end up being Uber of shipping. So these are, things which these are the values which resonate very well with our founding principles of looking towards future requirements. And in today's time, that's the clear focus. We want to work around asset light, digitally enabled, integrated logistics solutions. And in doing so, what we recognize is that everything that we have built over time does not fit into our strategy. There are four pieces which I earlier spoke about as well as our core business. They very well fit in the strategy, be it the EQ Worldwide, CFS ICD, Contract Logistics, or Express. But some of the other businesses, be it crane rental or other asset heavy businesses, do not necessarily fit into this strategy. So, therefore, on one hand, we have an approach to getting out of businesses which are non core, which do not fit into the overall strategy. And on the other hand, we have a sharp focus on growth in these four businesses. And when it comes to growth, we are open to both organic growth as well as inorganic growth. And as a company, we take pride in great success we have had in multiple acquisitions, in diverse cultures across, very distinct geographies. We have acquired companies of different scale and size across Europe, China, Americas, and of course in India. So therefore, you would hear about us getting out of businesses which are non-core, and you would hear about us expanding presence in what now forms the core of Allcargo. And we would continue to look at acquisitions as well as continue to drive organic growth. I hope that clarifies the bit of a distinction between the two. You're on mute, Sanjeev.
Sorry. Yeah, no, so I think I guess clarifies. Just trying to maybe understand when you look at acquisitions, what are you focusing on? Return on capital? Because again, as you said, you want to be in asset light models in general. But for example, so when you have done this Nordic acquisition recently, and so maybe just talk us through your thought process and what are the parameters you're looking at?
Right. So I think, like you rightly said, one of the biggest parameters, because ultimately every business is answerable to its shareholders. So one of the key parameters has to be the return on capital employed. Now, the return on capital employed for us is not just about what company is earning today, but it's in fact not, it's mostly about what the company can earn as part of our ecosystem. And many times there are incremental benefits, there are synergies that come in along with that acquisition. In many situations, we see an opportunity for a great turnaround or transformation. So we are always looking at future returns on capital employed. So while return on capital employed is an important parameter, we are not looking at the present, but always at the future potential. That's first thing which drives any acquisition decision. The second thing is strategic fitment. So we are not a company which is looking at incoming deals and then trying to see what makes sense. We are always more proactive in identifying what our requirements are and then cherry picking companies based upon our strategic requirements and what fits into that. So which allows us to go in with a very, very structured thought. And in most cases, we have gone with companies that we have also been extremely familiar with. So you spoke about the Nauticon acquisition, which is in our international business, EQ Worldwide. Let me take an example of two kind of acquisitions that we do in EQ Worldwide. One is a acquisition within our network. So historically, we have acquired many companies which were working with us, and they were our partners as agents, and we took over them. So we were familiar with the businesses, we were familiar with the people, and we took over those businesses, and that allowed us to have greater control, flexibility in the network, and that allows us the business to be growing faster. The second category of acquisitions is what we did with Nordicon, which is more strategic and outside our network. So a company like Nordicon, was not working with us. It was working with a competing network. But it's a great company having strong focus on, the values that we subscribe to, digitization, customer service, engagement, and all of that reflect in market leadership. They have substantial market leadership. Almost 40% of the entire Nordic region is controlled by them in the LCL consolidation space. And they control customer relationships as well. So as they come into EQ Worldwide network, uh, they also bring those volumes into our network, which means that our offices on the other side, which are handling import and export and that transport, also end up getting incremental synergy benefits. And by EQ Worldwide's global capabilities coming into Nordicon, they are able to improve procurement. So therefore, there are multiple synergies that we would evaluate, and then also try to see how we can, pick up what's good about the existing company and what it requires, and then kind of provide those resources, be it people, capital, technology, or whatever requirements are. Like in case of the other example, when we acquired Gati, we identified various transformational requirements that the company had, and we took care of them. So this is how we usually go about acquisition, very well thought out in the core domain that we want to grow in, and then we look for strategic fitment and then very attractive return on capital employed in a future state.
Right. No, that's pretty useful. So, just trying to also understand in terms of, I guess we sitting in India trying to analyze things sometimes is a challenge. And, we have seen many companies in India who have been like global under at some point. And things like, just trying to understand what is your right to win in the worldwide. What kind of moat have you created? Which is, why your client should come to you.
Yeah. So that's a very good question. And I think, each business today is trying to seek that distinct advantage which it could build over its competitors or, alternate offerings. And in our case, I can think of two distinct value propositions that we offer to our customers which are unmatched. One is built over a longer period, which is our network. And second, which is more recent, is our ability to use technology to their service. So speaking about the first one, ultimately cargo movement requires timely departure of the cargo and arrival at the end destination, which means the ability to provide weekly services, ability to provide direct services to the customer is most important to the customer. Now, when you have a full container to ship, it's very easy. You can just simply put that on the vessel which is scheduled to go. There are weekly sailings for multiple shipping lines. But when it comes to LCL cargo, ability to have enough load density to be able to run a global complex LCL network wherein you are, so when a shipping line is offering its service, they're offering a service for one container. That's the minimum load. The network that we operate, it offers, that 1 cubic meter cargo also has an access to a weekly scheduled departure. Now that's something which is not easy to replicate. That's something which has been built over, decades of sustained, expansion of network by way of organic as well as inorganic means. And that is something which is very distinct advantage. Nobody else in the world has that network capability that we have. And now it becomes an opportunity for us to further consolidate by keep continuously expanding and adding. Like, when we add the Nordicon network, it makes our network even more robust and more expanded. So that is the biggest advantage, which is very difficult to replicate because it's a very complex, like I said, thousands of port pairs, almost 2,400 plus direct trade lanes that we operate. So this is the biggest distinct advantage. And the second distinct advantage is the focus on technology. So if you look at the EQ360 platform that we have built, which is now being accessed by a significant number of our customers, the ability to get instant quotes. Now, while we're all as consumers used to getting instant quotes in our personal lives, in the shipping fraternity, instant quotes is still not an easy task, given that it involves collaborating with multiple partners. But because of our API integrations, our own control over destination offices, we are in a position to give door-to-door rates for a significant part of the global trade. And then beyond that, there are capabilities into intelligence through analytics and a lot of other capabilities which provide greater visibility, greater insights, greater transparency, and the booking time is reduced both for us and for the customers. The ease of doing business because of digitalization is one unique distinct offering that is not there at scale with our competitors, companies that we compete against. And second is the differentiated, unique LCL network. These are the two that come to my mind when you speak about the distinctions.
Right. Typically, like when you compete with people, how big are your competitors? Like compared to them, what are your size? Let's take top 2, 3 competitors that you have.
Yeah, so I think it's a business which has a few big players and then a long tail. So as EQ worldwide, when we speak about the EQ business, we have about 13% ballpark is the global market share that we control. And there would be two more competitors who would be in the range of 7 to 10, 11%. And then there would be maybe one or two in the 3 to 5% range. And then there'll be a long tail of, like 0.1 to 0.5% kind of market shares, local country level players. So that's the competitive landscape in the EQ worldwide business. In CFS business, it's more consolidated. In each location, we have about 8 to 10 key CFS operators when it comes to a market like JNPT, and slightly fewer when it comes to a market like, let's say, Chennai or Kolkata would have even fewer. And if we move into the third business, which is Gati, there the number of competitors is relatively even lesser, with primarily Safe Express, Gati, PCI Express, Blue Dart, Delivery Spot On. So these are the 6 or 7 key players who operate in the B2B surface express in the country. So that's what the broad competitive landscape looks like.
Sure. So on EQ worldwide, you are by far the largest, is what you're saying.
Yes, we are the global market leaders in LCL consolidation.
Sure. And also, just one question here, which kind of, these businesses have relatively low margins, right? But, if you give credit to your customer, are you running a risk in terms of, credit risk with the customers? How do you manage that?
Yeah, so I think these are mostly long-standing B2B relationships which have been built over a longer period of time. And when you look at the low margins, primarily that's also because the service that we are offering when it comes to LCL, for instance, is the consolidated network. There's a large amount of ocean freight which is almost like a pass-through cost, on which we give credit and we also receive credit. So therefore, two fundamental things that allow us to continue to operate. One is long-standing relationships, and second is credit on both sides. So that's how we typically operate. And when we look at the fast evolving FCL business that we do, again, it's a similar wherein shippers benefit from our large network and global procurement capabilities, wherein we are able to offer them better service on a door-to-door basis or on a warehouse-to-warehouse basis as they require. And we receive credit and we give credit as well. So naturally, the business requires working capital. And in an environment like what we are seeing today, those requirements have also gone up. But that has also meant that some of the larger, more stable players like ourselves have been able to sustain and provide the required services to the customers, as compared to many, smaller operators who could not manage their working capital and therefore could not sustain the service offerings to their customers. So I think difficult times make companies stronger, and that's what we are witnessing as well.
Sure. So if I look at the businesses that you talked about, the 4 businesses which are now the core factor, let's take for a minute the other businesses which are still there. What kind of return on capital is there in these businesses and average?
So you're talking about the return on capital employed for these 4 businesses?
That's right, yeah.
Yeah, so I think if you look at the return on capital employed for CFS ICD business, for us is more than 30%. For the international supply chain, the EQ worldwide business, it's again around the same range. In contract logistics business also, there again, in the current subsidiary, we have contract logistics and custom clearance business. We have already filed for a scheme of demerger by which contract logistics is being segregated from custom clearance. Again, like by the same rationale of core versus non-core. Contract logistics core business again gives similarly higher 30, clearly more than 30% kind of return on capital employed for us. And in Gati, at this point in time, the return on capital employed is lower because it's going through a transformation journey. But if you look at a steady state, it would also be in a position to offer very high return on capital employed. So therefore, if you look at these four core businesses, because they are asset light, the capital employed requirements are lower and they potentially generate a huge amount of profits. The return on capital employed is much higher.
Right.
And when today you see the consolidated results, many a times what gets merged is, two businesses. One equipment rental kind of business, which has significant depreciation. So whatever EBITDA you make on books, depreciation literally eats up all of that, and therefore your return on capital employed is near zero, even though you're getting cash returns. And
Right.
the profits only get booked, by way of exceptional income. When you sell those assets when they get old, because the actual value is slightly higher, but then that doesn't show up in the business income, that shows up in the exceptional income.
Right.
Or the warehousing business, which is more like, NVD returns. So for every 100 rupees you invest, you typically get 8.5, 9 rupees in annual rent.
Right.
So as a composite, it looks lower, but otherwise, if you look at the core businesses, they are all extremely high ROC businesses.
So once this whole demerging or selling off of assets or hiving off of assets happen, the whole business will look far more higher than what it looks today on paper. This is what you're saying.
Yes, that's exactly the idea as well. Over a period of time, we would continue to expand the offerings. You would continue to put more capital employed towards these core businesses, and you would continue to, reduce the capital employed. And, or like you are aware, there's a transaction going on the warehousing side, and we have been exploring on the other businesses as well. So yes, over a period of time, you should see the entire, when if these four businesses only were to be there, then you would have a very high ROC, as I explained.
Right. So you talked about the warehousing. Where are we on the warehousing business? Like where is the transaction at right now?
So in the logistics park business, basically each logistics park is under a separate SPV. And for a couple of SPVs, the shareholding has already been transferred. But for a couple of key warehouses, there were some conditions precedent to be met, which would have happened long ago if not for the COVID pandemic, because there were some government procedures to be followed, and many of the government offices were not functioning in full capacity. Now, expecting that there would be no subsequent third wave, which is tough to predict, but at least for now, looks like next couple of months we should see smooth operations. If that happens, then within the next couple of months we should be able to meet the conditions precedent, and another couple of significant logistics parks which are still on our books would also get transferred under the transaction that was announced last year.
Sure. So other than these logistics park, what else you are looking at to hive out? You talked about crane rental business and so on. What other assets are you looking that which you think are non-core and over a period of time can be moved out?
Yeah, so if you look at Gati in particular, we have several small properties which are not core to the business and which are not required. We have fuel stations business, which is again not at all core to the business or to our philosophy. So in Gati alone, we sense there's a potential of, almost about 160, 170 crores worth of monetization by selling off these assets ranging from fuel stations to land parcels, etc. So that's one core element. Then on the Allcargo side, we have these logistics parks for which we have already done the transaction with Blackstone. There is an optional asset in Jakhar for which is not part of the financial numbers which have been discussed, but there's an optional asset which would be discussed between Allcargo and Blackstone, and an appropriate decision would be taken after the current set of transaction is concluded. And then we have the project and engineering division, which I spoke about, the crane rental and the asset-based, project transportation. And then there would be some smaller, assets in Allcargo as well on the real estate side, which would not be absolutely core to the four businesses that I spoke about.
Sure. So, actually, one last question from my side before I hand it to Shailesh. I guess we can't talk to you without talking about the current situation, what is going on. What's your view in this whole supply chain getting completely clogged, ports shut down in China or what have you? So, what's your sense? How long will it all take to kind of get back to normal?
Yeah, so I think if you look at the underlying causes for the same, there have been two or three key trends. One, because of frequent, varied lockdowns across different countries, you find that your transit times have increased, your containers are stuck, your hinterland logistics is slightly more constrained. So that's one set of hindrances which have caused a sudden shortage of inventory in the supply chain assets. Second biggest driver has been US, which is one of the largest markets. And as people were not able to travel, people were not able to spell out on various services, entertainment, etc., the consumption went up big time in US, and which led to significant purchase of goods, and that led to an unprecedented increase in imports while the exports went down. So, that kind of a huge imbalance in trade for perhaps the world's, biggest market led to a significant imbalance in the global supply chains, and that became the other contributing factor. And the third factor has been, unfortunate incident, whether it was the Suez Canal blockage or, some ports getting closed because of the pandemic. Now, if you analyze each of these three factors, the US situation is not going to change overnight. The consumption patterns, most, people expect them to continue to sustain. If you look at the disruptions, they would continue to reduce as the situation improves. So my personal sense is that you would find situations slightly improving in 3 to 4 months' time as the pandemic situation improves. And for it to really resolve to a substantial degree, we would need to wait till new shipping vessel supply comes into market, which could be towards the end of next year. And would it still go back to the pre-COVID levels? That's something which we don't think it would go back to that level. It will possibly still end up being slightly above the pre-pandemic levels.
Right. Thanks. Shailesh, over to you.
Yeah, thank you, Mr. Ravi, for your time. My question is on MTO side. The last 10 years, we see whenever freight rates goes up, our EBIT per TEU also goes up. So in 1Q FY22, freight rate was 1,30,000 and EBIT per TEU was 6,000 rupees. So what kind of increase we see EBIT per TEU due to recent sharp increase in container freight rates?
So there are two core business segments in our business in the international supply chain. One is LCL and second is FCL. As far as FCL is concerned, in higher freight environments, our margins also go up because we have an opportunity to, earn improved margins. However, when it comes to LCL consolidation, there the freight is more or less a pass-through cost, and therefore the freight rate increase or decrease does not impact the margins much. In fact, the way business operates, it works with a gross margin per unit, per CBM kind of a focus, wherein ocean freight is seen as a pass-through cost. So in LCL, you would find lesser volatility. In FCL, you would find a slightly greater degree of correlation between the freight environment and the potential margins. That's how I would, put it. So if you look at in a continued forward direction in FCL, as long as the environment remains strong, these similar margins would sustain, or otherwise there could be a slightly marginal correction. In the LCL side, the margins would sustain even if the freight rates were to normalize because they are significantly decoupled from the operating freight environment.
So recently, we have seen container freight rates going up 4x actually price. So do we see similar kind of jump in EBIT per TEU?
No. So those 4x or 10x are also, anomalies because rates, on trade lanes where rates go up significantly, those are the ones which also get picked up in new circulation. But if you look at, in our case, you could look at our revenue per unit volume, or you could look at the various global freight forwarders which are listed and information is available. You would find that it's almost like a 50% on an overall global base, the escalation that we're talking about. And if you look at our own performance, it's a combination of significant volume growth, which has happened on the back of a comprehensive transformation program we've been running. And fortunately, that we have coincided a transformation program for us, which allowed us to expand volumes significantly and a favorable operating freight environment as well. So it's a combination of both. But otherwise, if you look at from an LCL perspective, these gross margins would continue to be sustained. And in FCL, there could be marginal corrections as the ocean freight rates normalize.
Your business, how much is spot and long-term contract?
So on the supplier side, I would say approximately 70 to 80% capacity is usually contracted and 20-30% is on the spot. And in terms on the selling side, when it comes to larger accounts, you would typically have, most of the capacity requirements being contracted rates would be there.
Okay.
But as you move towards the smaller tail of customers, you'll be moving more and more towards the spot. But when I talk about these contracts are also mostly 3 to 6 months long, and they're not like multi-year service contracts. And therefore, as the freight rate environment changes, you also bring changes in the rates in those contracts.
Okay.
Yeah.
Actually, we have been growing more than 2-3x over global container growth due to market share gain or acquisitions. In future, on the acquisition side, what are all the plans? How much capital we are going to deploy in the MTO business?
Yeah. So that's a good point you highlighted on the growth. There are three factors driving growth for us. First is, industry growth rate itself is higher. Second is, our market share gain, and third is acquisition. And when I speak about the industry growth rate being higher, what I mean to say is if you look at globally, two key trends which are emerging are one is cross-border e-commerce with companies like Amazon and Alibaba driving a global, growth in cross-border e-commerce. And second trend is small and medium businesses are going international. So the EXIM trade of small and medium businesses is growing significantly across the world, not limited to any one country. And when it comes to cross-border e-commerce and small and medium businesses trading, cross-border, both these opportunities lead to a significant expansion in the LCL trade. And therefore, you would find that the LCL growth rates could be up to 2 times the growth rates of the overall ocean freight globally. And when it comes to the other segment in FCL, there we have an opportunity to anyways grow faster because we are still on a very small shareholding in the overall market. And therefore, we have continued to grow at near 20% growth rates over last several years. And we believe that such high growth rates are sustainable going forward as well. So therefore, first part is in the market growth rate as well for itself for us, there's a good opportunity. Secondly, on top of that, we have been focusing on digitization, improved services, and several other transformation initiatives to increase market share, which we are witnessing. And when it comes to acquisition, we continue to look for acquiring incrementally, which is some of our existing agents which are still there in the network. Plus some more opportunities are there, such as Nordicon, wherein we can either expand into markets where we're not present, or there are also opportunities to consolidate presence in markets where we are there, but perhaps competing head-to-head, with a key local player who also has strong local relationships, which means that, a similar player like Nordicon, which could come in to the queue worldwide. In terms of the appetite, as we are focused on a completely asset-light business, we are completely, capex light. Even IT expenses are more on a, software as a service or, on a service model. It's all going into OPEX. So whatever comes off as a bottom line is all available to, invest back if there's a good opportunity. So we have strong appetite for continued inorganic expansion as well.
So because of this digitization, what is the incremental volume and margins you are targeting? Can you throw some numbers?
Yeah. So I would say, in terms of the digitization, it is difficult to, at this point in time, ascertain the additional, bottom line impact, because bottom line impact of digitization comes in only when you have automated and, your backend operations as well. And we are a couple of years away from that complete, digitization impact. What we're doing today is something which is facilitating customers and significantly high digital adoption. And there are 90% plus kind of customer satisfaction scores, meaning that customers are liking the service. Therefore, it is increasing the customer stickiness. It is little impossible, little difficult, or I would say rather impossible to say that the customer stayed back because of digital or because of service or because of multiple other parameters. But digitization is clearly helping us retain customers, increase the customer stickiness, and even the new customers that we win over are more likely to stay with us, and that helps us expand the market share. But in terms of the quantified impact, it can only be assessed, when there's more automation and digitization across operations as well.
Also, in the MTO business, there are multiple subsidiaries, and the main cash cow is ECU Worldwide, which is sitting in foreign subsidiaries. So the cash generated there, how do we intend to bring the cash to the standalone entity? Does the standalone entity has any dividend policy with ECU MTO business? And what can shareholders of Allcargo expect in terms of dividend?
Yeah, so I think if you would look at our track record, we have always had consistent dividends coming in from EQ Worldwide to Allcargo, and we've also had consistent dividend payout from Allcargo as well. So our track record of consistent dividend payout would continue. And as far as EQ Worldwide is concerned, like I said, we use capital to grow by acquiring businesses or by historically, we have also invested in growing IT capabilities, etc. But as we move forward, now we are looking at moving almost everything into OPEX, and the additional cash flows would either be utilized for acquisitions or would largely, some part of it also goes back into expanded working capital, particularly in times like these. But otherwise, most of the cash surplus would flow back as dividends into the parent company, and what is not required for a strategic acquisition, for an instance. And then if there's a cash required at Allcargo level, we make use of that for driving growth. The company is focused on growth, but at the same time, there is a consistent dividend payout as well.
Okay.
So we see the same trend continuing, being consistent in dividend, and at the same time being very focused on growth as well.
Okay. My next question on CFS side, despite TPD and dwelling days coming down, we are acquiring speedy. We are definitely seeing good potential in this business. How do you see CFS business model evolving here?
Yeah, so I think in CFS business model, thanks to great government initiatives and facilitation of trade, CFSs are now playing the role of being an important node in the supply chain rather than playing the role of being a byproduct of inefficiencies. And today, you have direct go deliveries, and some cargo comes to CFS after the with SDPD CFS, while some cargo comes in directly as well. CFS are allowing trade to plan for resilience in its supply chain by using the CFS warehouse and the container yards to plan for the shipments, and particularly in the crisis time, the importance goes up even more significantly. As we see ahead of us, we believe that CFSs can play a lot more role in the entire trade facilitation, and we have been, sharing our views as an industry, not as a company, with various government bodies as well. And government also has been looking at the national logistics policy, and they've been taking a comprehensive view on many things. So we believe that in future, CFSA should continue to evolve and play a more vital role in the EXIM supply chain of the country. Two key important things to note is One, unlike international terminals, which have huge infrastructure and storage space, in India, most of the container terminals are constrained on space. And therefore, what we see as CFSs in India are primarily extended arms of the port terminals, which allow it to operate efficiently because there are capacity constraints inside the port. And this model kind of works well. And now, in fact, some international markets are also adopting this model. Customers have convenience in interacting with a CFS rather than a port terminal directly. And on the dwell time impact, which you emphasized upon, the key thing to note is, if the container is staying for a shorter duration, it improves the handling capacity of our yards as well. So, for an example, if a container yard can store 4,000 containers and the dwell time was 20 days, that particular CFS could only handle 6,000 containers in a month. But as the dwell time over the years has come down from 20 to 10 days, the same container yard can now handle 12,000 containers in a month. And it's on the same capital employed towards construction of yard, warehouses, facilities, equipments, land, etc., wherein you can do more business. So for companies which can potentially generate higher business, reduced dwell time offers an opportunity to gain incremental revenue without further capital expansion.
In that case, do you see increasing margins?
So what you would see is margins on a per TU basis would not increase, but like I explained, your ability to handle more TUs from the same facility means that you're not constrained. You can continue to grow for many years to come. And as India is talking about the whole focus on manufacturing, everybody is very bullish about the country's ability to continue to drive exports. All of that growth would require gateway ports and the CFS infrastructure. So with the reduced dwell time, we would be able to continue to grow and handle more and more volumes without having to invest in additional capex. So that is the way to look at it. So EBIT per TU may not grow, but your number of TUs will continue to grow, driving the overall absolute margins.
What is the current consolidated debt is 1,400 crores. Can you please share net debt breakup between each of our business vertical, and what kind of reduction you see in debt in each of the business vertical?
Yeah, so I would say if you look at debt, I would first speak about the key subsidiaries.
Yeah.
In Gati, we had a debt of over 400 crores in 2020. That debt has already come down below 200 crores, and it would continue to go down, and we would only be left with the working capital debt in the business, which you would retain maybe at an optimal level of 120 crores. We don't see above those levels. In the international subsidiary EQ Worldwide, the debt is again largely working capital debt, which we estimate should go down over the next 6 to 9 months by about 15 to 20% as the freight rates normalize. On the Allcargo side, CFSs don't really require much of a working capital. We have some working capital in the other businesses, contract logistics and P&E. But large amount of debt that we see in Allcargo books was towards two key initiatives. One was Gati acquisition, and second was the logistics parks. Now, on the logistics park side, you would see approximately 300 crore debt reduction as the Blackstone transaction gets consummated. So that's the loan amount sitting in those SPVs, which would no longer be part of the consolidation. And there's another 100 odd crore sitting in as debt, which would convert to equity as the deal gets consummated. So there'll be an impact of almost 400 crore on the Allcargo books as the Blackstone transaction gets concluded. And in another big logistics park in Jakhar, we have almost approximately the same amount of 400 crores of debt. If you look at the Allcargo's 1,000 crore debt broadly, 400 crores will go away with the Blackstone deal, leaving behind 600. And out of that 600, 400 crores is largely in Jakhar, and the rest of it is towards working capital. The Gati acquisition debt, therefore, in a way, has already been taken care of through the internal accruals. That's one way to look at it. So as we continue to, reduce the investment in the warehousing logistics parks, you would see that this 1,000 crore number would first come to 600 crore as the Blackstone transaction gets consummated, and then it can go down further.
Okay. So this logistic part, this Blackstone deal is very complex. What is the total money he has bought it by way of equity and OCD? And in equity, is there any put option, and what is the terms? The OCD, what is the terms of put option? So when it will be converted, and what is the exit price you have promised? Can you please explain in details?
Yeah. So basically, if you try to understand the Blackstone deal, it's basically all the logistics parks are sitting in separate SPVs. So there's a Hyderabad logistics park which is sitting in an Hyderabad SPV. There's a Malu logistics park in Bangalore sitting in a separate SPV. So think of it as each logistics park is sitting in a separate SPV. And when Allcargo had acquired some of these land banks from various government bodies, like in Hyderabad, it was acquired from the erstwhile Andhra Pradesh government. We had acquired land banks in Indore from Madhya Pradesh government, and in many cases, and in some cases, we had acquired from private aggregators as well. This land was acquired at a historic price, and therefore, when we moved them into SPVs at the fair market value, that was the first instance when Allcargo booked profits, and which is what we reported in the December 2019 ending quarter. Now, when all these businesses have been transferred to these respective SPVs, there is a debt component, which is the debt which is sitting in these companies, whether it is construction finance, LRD, or debt from the parent company itself, and there's an equity contribution. Yeah. Now, for these logistics parks in Goa, Karnataka, Telangana, and these locations, which are basically excluding Jhajjar, as we've explained in our presentation, spoke about in the past. These logistics parks put together, the transaction has been done at an equity value of 420 crores. Okay. And out of that 420 crores, because we are giving away 90%, 380 crores basically comes to Allcargo. And that is how the equity value is. And obviously, because all these SPVs also carry a significant amount of debt, like I spoke about an example of 300 crores debt, which is in the SPVs which are not transferred yet. There is additional debt in the companies which are already transferred. So the enterprise value was higher. The equity value was agreed at about 420 crores. And that is how the transaction is structured. Okay.
The 16% rate, that is absolute or per annum basis?
Which 16% rate are you referring to?
OCD. Debenture.
Yeah, no, so we have a 6%, not 16%. 16%.
No, sir, it is 16%.
So 16% is, in case the transaction falls through, if the transaction does not get concluded, then 16% rate is to be paid. Okay. Yeah. So on the money invested by.
This is per annum basis or how it is?
Yeah, it's 16% per annum basis. In case the transaction falls through for any reason, then that's the 16% number.
Okay.
Which, as I explained to you, is not the scenario. There has been a delay on account of the pandemic, but now, since the offices are back to functioning, we anticipate that over the next couple of months, this should get consummated.
Oh, that is great, sir. Yeah. So in Gati, rupees 179 crores assets for sale. Does it include fuel station as well? Or how soon this will go from the balance sheet?
Yeah. So all the properties, whether it is fuel station or the office, some of the office buildings which we don't see core to the business, which we can very well lease, or some of the idle real estate which is not being put to any use at all of that is part of that assets held for sale, and we have plans to monetize them. And like I mentioned earlier, we expect over the next and again assuming normalcy in the situation, we expect that over the next 6 quarters we should be able to conclude the asset monetization drive, and that should give us almost ballpark 170 crores odd.
Okay. So what is the capex plan for the company next 2 years? Allcargo and Gati, if you could give separately, would be very helpful.
Almost nothing, I would say insignificant. We are extremely committed to the focus on being asset light.
Okay.
We are moving into a completely OpEx model, even when it comes to, like I mentioned, even when it comes to digital, opportunities. We look at investing into per use model rather than, buying into the IT capabilities. So almost everything will be on an OpEx basis. For instance, Gati would not have more than a 10-15 crore capex. Other businesses also would have very minimal capex. The only capex would be to some extent still in the logistics parks business, wherein some amount of construction is still pending.
Okay.
But in the four core businesses, we do not see any requirement for capex.
So if that is the case, operationally, what kind of debt reduction you see in next 2 years? That excluding sale of non-assets, non-core assets, then Blackstone, excluding that, operationally, since there is no big capex, so what kind of debt reduction you see next 2 years?
So yeah, so like I said, there's not going to be any significant capex. Debt reduction would be dependent upon the funds from internal accruals available for repaying debt, and that will be dependent upon the acquisition opportunities. But apart from good acquisition opportunities which we continue to explore, we would not need any significant amount of capex. So whatever internal accruals are there would be used to retire debt.
Okay. Thank you, sir. Sanjeev, sir, you have any questions?
No, I think that was pretty comprehensive. Anything that we missed out, do you think you would like to add?
No, I think you've covered all the businesses and spoken about all the key aspects, be it financial or strategic. I think one key thing which is driving across our businesses is the transformational mindset. Over last couple of years, the entire management has been working with multiple transformation partners, be it McKinsey in EQ and Allcargo setup, Alvarez and Marcel in Gati. We're working on finance transformation with KPMG. We're working on IT transformation. So the whole organization today has a DNA of a startup. If I look at it. So everybody is thinking about what new opportunities lie ahead of us. How can we be agile? The customer centricity, which is one of our core values, is truly coming to its fore. So I think it's very exciting to operate in this fashion, wherein we are not thinking about the legacy that is being built, but we are always talking about, what new opportunities lie ahead of us. How can we disrupt our own industry? Because that's the only way to grow, to disrupt our own selves before somebody else comes in with an opportunity to disrupt us, right? We have so much of experience and focus on technology. That's what we're trying to do, trying to use digital tools, capabilities, and a lot of key talent joining us as well in driving business in a very, very sharp focused way, I would say.
Right.
So that's what we've been trying to do at Allcargo and across the group companies.
That sounds pretty exciting. I just hope that with the stock prices having gone up, I hope this delisting part. I know that's a promoter issue. Promoters have to take that call. But the delisting noise that keeps coming in once in a while, that's over for now, I hope.
Yeah, that is already concluded. That's already over.
Yeah.
I think the delisting process was announced more than a year ago in a very different environment, and that process has already been, the shareholders have already recommended to remain listed, and promoters have also expressed that they would continue to explore opportunities for growth while being listed. Yeah, so delisting is already well behind us now.
Okay, great.
Yeah.
Great, Ravi. Thank you so much for spending your valuable time, and wish you all the best for this whole morphing of the business, and as you said, a startup mentality.
Absolutely, so we have come a long way, but we are also just about starting on the new journey. So thanks, Sanjeev. Pleasure talking to you.
Very nice talking to you. Thank you. Thanks, Ankit.
Yeah. Thank you, sir. Thank you.
Thank you. Yeah.